Chinese consumer downgrading becomes a trend, fierce price wars reflect economic downturn. Cangzhou bank run is just the tip of the iceberg. Large state-owned banks in China is the financial institution with the largest number of consumer complaints. Infrastructure investment could be the next domino to fall in China. It's all covered in today's China Truths. Chinese consumer downgrading becomes a trend, fierce price wars reflect economic downturn. When mainland China finds itself in an economic crisis, the population has minimized their consumption habits, marked by tightening their purse strings and searching for simplified and practical solutions. In this scenario, a fierce price war has erupted across various sectors, both online and offline, encompassing large and small car manufacturers, as well as the food and snack industry. In specific, an article from 21 Economic Net, published on October 10, has provided a comprehensive account of the situation. Firstly, the price war kicked off early this year among the three major e-commerce platforms. In March, JD.com introduced the 100 billion subsidy strategy, marked by significant price reductions, which led to substantial growth in the number of corporate merchants on the JD.com platform during the second quarter. In response, another e-commerce platform, Taobao, swiftly initiated the 5 strategies, including price power, thereby intensifying the price war. Pinduoduo continued its approach of offering low prices. Secondly, price reduction and sinking have also become the dominant themes for many offline brick-and-mortar retail businesses. Notably, in the first half of this year, the automobile whole vehicle retail industry witnessed a significant price war. In the first quarter, car manufacturers like Oriental Citroën were the first to announce price reductions for gasoline cars. Shortly afterward, the price war extended rapidly to the new energy vehicle sector. Under the guidance of major car manufacturers, dealers nationwide introduced various discount measures to significantly lower prices, even resorting to selling vehicles at half price without hesitation. In the restaurant industry, a fierce price war has erupted within the freshly brewed coffee sector. It all began in April when Kuti Coffee kicked off a campaign offering coffee at 9.9 yuan, approximately $1.36 per cup, setting the stage for this price battle. Luckin Coffee, a major rival of Ku Cafe, quickly joined in by reducing prices and committing to a 2-year price freeze policy. However, Kuti Coffee later dropped the price of its lattes to 8.8 yuan per cup. Taking the competition to an extreme, Lucky Coffee directly slashed the price of coffee to 5 yuan per cup. Additionally, snack brands have also been significantly reducing prices this year. For example, Nongfu Spring, typically priced at 2 yuan, is now available for 1.2 yuan, while Beishishan, usually priced at 3 yuan, is now being sold for 1.8 yuan, among other similar discounts. Report indicates that the discount rates for flagship products from well-known brands are generally between 30% to 40%, and these products are not close to their expiration dates. Just a month ago, a trending topic emerged on social media platforms like Weibo, titled "Say Something to Prove You've Downgraded Your Consumption." On Douban, a Chinese social website, the group "Have You Downgraded Your Consumption Today?" has gathered over 360,000 members. This shift toward consumer downgrading and heightened internal competition across various industries is the prolonged economic downturn in China and the persistently high unemployment rate. Official data released by the Chinese Communist Party, CCP, showed a brief resurgence in national retail sales between January and May earlier this year, after the zero-COVID measures were eased. However, it subsequently slowed down significantly and has not yet returned to pre-pandemic levels. Data from China's Ministry of Culture and Tourism revealed that during the peak travel season of the Dragon Boat Festival in June, per capita spending by domestic Chinese tourists increased by 8% compared to the same period the previous year, during the zero-COVID period. Still, it declined by 14% compared to the same period in 2019, pre-pandemic. Given the CCP's inclination to present data favorably, many believe that the actual purchasing power of the people is even weaker than these figures suggest. Cangzhou bank run is just the tip of the iceberg. The Evergrande crisis is escalating. Following authorities' arrests actions against Su Jiayin, an online list of Evergrande's outstanding bank loans has surfaced, exposing a debt of up to 3 billion Chinese yuan to Cangzhou Bank. As previously reported, starting from last week, Cangzhou Bank experienced a bank run, with its branches becoming overcrowded. People queued up to withdraw their money around the clock. On October 10, numerous videos circulated online, showing depositors waiting in long lines at various Cangzhou Bank branches to withdraw their funds. Some branches had lobbies filled with people. In addition, depositors tried to transfer their bank deposits online, although online transfers were temporarily suspended. Despite Cangzhou Bank's reassurance that Evergrande owed the bank 346 million yuan, not 3.4 billion yuan, it didn't dissuade the depositors who continued to seek withdrawals. 3 government financial departments in Cangzhou jointly released an urgent announcement to dispel the concerns surrounding Cangzhou Bank, urging the public not to believe or spread rumors. Meanwhile, Cangzhou's public security authorities confirmed that they had detained a significant number of people responsible for spreading false information. When questioned about the sources of these rumors, the police declined to disclose that information at this time. Regarding this issue, Chinese affairs expert Wang He analyzed on the 11th that the CCP is currently taking extensive measures to control the flow of information. No one knows who leaked this information, only insiders have this knowledge. It's virtually impossible to find this information online. But the current challenge is that Evergrande's bank borrowings amount to approximately 7 to 800 billion yuan, spread across over 200 banks. If widespread panic takes hold, it may lead to significant problems. Why the panic? Independent commentator and writer Cangzhou analyzed, the banking system primarily relies on confidence, and when that confidence is lost, depositors might rush to withdraw their funds, potentially causing a significant crisis even for large banks. Moreover, local commercial banks themselves have relatively small asset sizes and are ill-equipped to handle extensive bank runs. If the number of depositors seeking withdrawals reaches a certain level, it would undoubtedly paralyze the bank. Reports have surfaced that the People's Bank of China, the central bank, provided overnight funding support to Cangzhou Bank, and Cangzhou Bank has now restored online transfers. However, it remains uncertain whether the bank run situation has completely subsided. Cangzhou believes that the bank run at Cangzhou Bank is only the tip of the iceberg in the real estate crisis. The more significant part of the iceberg may revolve around trust and investment companies, including Zhongrong Trust, Minsheng Trust, Shandong Trust, and others, all of which have also been reported to have stepped on the thunder, a colloquial phrase in Chinese that means encountering an unforeseen crisis. Analysis: China's financial crisis is inevitable. Taking a historical perspective, the CCP has effectively managed financial risks in the past. According to Mr. Wang He, due to the CCP government's control over all of the country's resources and power, in 1998, the 4 major state-owned banks were on the brink of bankruptcy. However, the CCP divested these assets and subsequently took them public. Within a decade, they emerged as the world's most significant and profitable banks. Yet, during that time, China's economy was on an upward trajectory, attracting substantial global investments, and there was considerable optimism about the entire Chinese economy. Mr. Wang explains, with various supporting factors in place, the banking system managed to recover. However, the current challenge lies in the fact that the fundamental historical conditions have changed. The international community is pessimistic about the Chinese economy, which is on a downward path. Capital is leaving. This is occurring at a time when the colossal debt within the real estate sector, including companies like Country Garden, is alarming, and many are confronting a financial crisis. Mr. Wang points out that in this scenario, the CCP's control over the national financial system, regardless of its strictness, is no longer effective. The system has been hollowed out internally, with capital outflows, resulting in an empty facade. Over the past couple of decades, starting from as far back as 1998, there has been a fundamental shift in historical conditions. At this juncture, despite the CCP's enhanced political power and tightened control, the foundation has been eroded. Hence, the eruption of a financial crisis in China is, one might argue, unavoidable and cannot be averted. Large state-owned banks in China is the financial institution with the largest number of consumer complaints. The State Administration of Financial Supervision of the Communist Party of China recently released the situation of consumer complaints in the banking industry in the first half of 2023. Consumer complaints data show that starting from the first quarter of this year, the number of consumer complaints from large state-owned commercial banks has exceeded that of joint stock commercial banks. The number of complaints in the second quarter continued the trend in the first quarter, and large state-owned banks have become the institutions with the largest number of complaints. Take the notice on consumption complaints in the banking industry in the jurisdiction in the first half of 2023 issued by the Shandong Supervision Bureau of the State Administration of Financial Supervision and Administration of the Communist Party of China as an example. In the first half of 2023, there were a total of 1,882 consumer complaints in the banking industry within the jurisdiction of the Shandong Supervision Bureau, a year-on-year increase of 75.07%. Among them, 447 cases involving large state-owned commercial banks, accounting for 23.75% of the total complaints, 295 cases involving joint stock commercial banks, accounting for 15.67% of the total complaints. Specifically, the total number of consumer complaints in the banking industry within the jurisdiction increased by 807, of which, the number of complaints involving large state-owned commercial banks increased by 305, an increase of 214.79%. In addition, judging from the banking consumer complaints in each jurisdiction announced by the Shanghai Supervision Bureau, Shenzhen Supervision Bureau, Hebei Supervision Bureau, Inner Mongolia Supervision Bureau, and Tianjin Supervision Bureau of the State Administration of Financial Supervision and Administration, the number of consumer complaints against large state-owned banks in the above jurisdictions has increased year-on-year. They are 201.96%, 334.22%, 263.62%, 126.37%, and 395.83% respectively. Judging from the types of complaints, in the first quarter of 2023, there were 59,827 complaints involving personal loan business, accounting for 57% of the total complaints, 32,142 complaints involving the credit card business, accounting for 30.6% of the total complaints. The number of complaints about the personal loan business exceeded that of the credit card business for the first time. China's state-owned banks include Industrial and Commercial Bank of China, Agricultural Bank of China, China Construction Bank, Bank of Communications, Postal Savings Bank of China, China Development Bank, Export-Import Bank of China, and Agricultural Development Bank of China. The six major state-owned banks generally include Industrial and Commercial Bank of China, Agricultural Bank of China, China Construction Bank, Bank of Communications, and Postal Savings Bank of China. Infrastructure investment could be the next domino to fall in China. A slowing economy, crackdowns on shadow financing, and plummeting earnings from land sales are crimping China's local government spending power that could likely force them to slash their infrastructure spending, experts fear. But worse, after the property sector, investments in China's infrastructure are seen as a potential second domino to fall. Andrew Colliers is a China analyst and managing director at the Hong Kong-based Orient Capital Research. He said, China's local governments are running increasingly higher deficits that will limit their ability to spend their way into growth. The central government, he added, has been cracking down on off-balance sheet or shadow financing due to concerns about financial risk. And because the property market is unlikely to rebound strongly in near future, their revenue from land sales will be limited. Gary Dugan, a chief investment officer at Dalma Capital and a foreign investor in China, said land sales alone are estimated to have funded 40% of their spending. In the absence of a significant transfer of funding from central government to local government, China's growth could stall. Although local governments have historically been a key driver of China's economic expansion, this year's weak growth, low tax revenue, and crippling COVID restrictions severely weakened their financial footing. Yet, while the decline in state land sales revenue follows a nationwide crackdown on debt in the sector, risks of default are expanding as well for local government financing vehicles, LGFVs, and shadow banks, since the property industry accounts for around 20 to 30% of the Chinese economy, including linked sectors. Chinese financial institutions provide loans to real estate developers, who typically lease or purchase land from municipal governments. Local governments utilize revenue from diverse sources, such as the sale of land, to fund infrastructure and public projects through LGFVs. That aside, more financial hardship is on the horizon as local governments must make debt payments in the coming month, reducing their flexibility to comply with Beijing's requirements to increase spending. Many of them have already resorted to salary cuts, staff reductions, subsidy cuts, and even the imposition of unreasonably large fines to balance their budgets. Mr. Collier said, therefore, unless Beijing is willing to institute a new tax system, local governments are going to struggle to pay their basic bills. So, about the situation of infrastructure investment, Adam Wolf, an emerging market economist at the London-based Absolute Strategy Research Limited, wrote, "The next domino to fall will likely be infrastructure investment. And it's likely to happen soon based on our estimate of the broad budget deficit, which includes LGFV borrowing." End of land finance era? For more than a decade, China's authorities have been grappling with the dilemma of how to move domestic demand away from real estate without triggering a financial crisis or damaging to the economy. They believed they found a solution in 2020. The 3 red lines, financial regulatory guidelines, were supposed to carefully regulate developer leverage and compel them to sell down their inventory, example, undeveloped land, projects under construction, and completed but unsold apartments, and stop utilizing presales from one project to fund the start of their next. But things didn't go as planned. As Evergrande flirted with default in mid-2021, buyers became wary of buying pre-sold flats from other private developers. Property sales plummeted, and more developers fell into financial difficulties, compounding the problem. But up until now, officials have been unable to break this cyclical pattern of failure, say analysts. Adam Wolf wrote, "Country Gardens was just one of many developers that hit hard times after a continued decline in sales in April. While the prospects for financial stability and the real economy could reverse eventually," he added, "it is not going to be possible to shrink the real estate sector without also breaking the broader growth model that has underpinned China's urbanization and industrialization for the past 20 years. So the real estate crisis will have a profound effect, and the use of land as a source of finance is no longer viable." A daring high-wire act with a high probability of failure. For the time being, though, local governments have been generating funding for infrastructure projects through special purpose bond (SPBs), which are backed by the central government and have been a source of financing for several infrastructure projects. For instance, Mr. Dugan estimates that in the first 7 months the total bond issuance was up 130%. He said, as long as there is an investor appetite for the SPBs, the local authorities should be able to fund their infrastructure plans. But the only concern is that some of the cash flow from SPBs has been directed towards propping up the financial sector that has been hit hard by the setback in the real estate sector. Besides, much of the criticism of the infrastructure projects is whether they have been in the right sectors. Nevertheless, with many provinces facing higher debt pressures and refinancing risks due to their weakened fiscal conditions, and the central government introducing new rules and regulations, such as allowing swapping of their hidden debt into bonds, Mr. Wolf believes infrastructure investment bond issuance will certainly crash. Mr. Wolf wrote, "China's policymakers are engaged in a daring high-wire act with a high probability of failure. They're attempting to dismantle the financing structures that have underpinned the country's growth model for the past 20 years. Even if they succeed in the longer run, growth may slump toward 3% or less over the next few years as the land finance model collapses. Don't forget to comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China Truths, and thank you for tuning in.